It's Monday, 1st of June, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. Apologies for the brief gap in your feed. We're back with a fresh episode and committed to keeping the regular momentum going.
Absolutely. It is great to be back.
So if you checked your portfolio this morning, you probably noticed a whole lot of red. The sentiment on the street from the previous trading day's close was, well, decisively bearish. We saw the Sensex contract by 1.44%, and the Nifty followed suit, dropping by 1.5%. So what's actually driving this broad-based sell-off across the board?
Well, we're basically dealing with a massive wave of foreign portfolio investor outflows, and that's colliding head-on with a highly volatile geopolitical landscape. FPIs are aggressively pulling capital out of emerging markets right now.
Right, moving to safer bets.
Exactly. In times of severe uncertainty, institutional capital just flees to the safety of U.S. dollar cash reserves. And the underlying catalyst driving all that fear is, the intensifying situation in the Middle East. Energy markets are flashing some major warning signs. Brent crude actually climbed 2%.
Wow. But that 2% jump in crude, that doesn't happen in a vacuum. What's the specific trigger on the ground pushing those energy prices up so fast?
It's a direct reaction to Israel expanding its military offensive deeper into Lebanon. And concurrently, diplomatic back channels are just breaking down. Tensions have really flared over a potential U.S.-Iran deal.
Which is probably off the table now.
Yeah, it looks highly unlikely to materialize. So when diplomacy stalls like that, Iranian barrels stay off the global market, and traders immediately price in the worst-case scenario for supply disruptions.
This feels less like a normal market dip and more like a geopolitical risk tax, right? A tax slapped onto every container ship and oil tanker moving across the globe. Every time a headline breaks out of the Middle East, the cost of doing business just goes up. But I really want to understand how this trickles down. How does a macro-level conflict thousands of miles away suddenly become a margin problem for a company headquartered here in Delhi?
The main collection point for that risk tax is the Strait of Hormuz. It's one of the world's most critical maritime choke points, and the blockade risks there are escalating daily. This is forcing immediate physical changes in how Indian corporate strategy actually operates.
Like who, for example?
Well, look at major consumer goods giants. Companies like Dabur and Britannia, they rely heavily on West Asia for sourcing raw materials and also as a manufacturing hub. Because of those blockade risks, they're rapidly shifting their manufacturing bases and sourcing routes entirely away from that region.
Wait, really? Where are they moving to?
They're pivoting toward places like Egypt and Turkey. The goal is to secure Mediterranean access and basically bypass the choke points altogether.
But I have a hard time believing it's that seamless. You can't just pack up a massive manufacturing and supply chain operation and move it to Cairo over a weekend. You're breaking established vendor relationships, signing new real estate leases, setting up entirely new logistics corridors. So who is paying for all that friction?
The companies are absorbing it, and the friction costs are enormous. It fundamentally disrupts their working capital cycles. When you reroute supply chains, freight insurance premiums skyrocket and transit times lengthen.
So their cash just gets tied up in inventory sitting on ships taking longer routes.
Precisely. And this pressure isn't isolated to just fast-moving consumer goods. The Indian energy sector is facing a massive structural headache right now. Our refiners are being forced to dramatically adapt their crude processing mix.
Let's break down that crude mix, because refineries aren't just giant boiling pots where you can throw in any type of oil, right? They are highly calibrated for specific chemical profiles.
They are incredibly sensitive. Most Indian refineries are optimized for specific grades of Middle Eastern heavy or sour crudes. So when the Strait of Hormuz is threatened, they lose reliable access to those preferred barrels.
And they have to scramble to find replacements.
Exactly. They hit the open spot market to find alternative barrels, maybe lighter, sweeter crudes from West Africa or the U.S. But processing those alternative grades results in lower efficiency. You get a lower yield of high-margin fuels, like diesel.
Oh, I see. So their input costs go up from the spot market, while their highly profitable output goes down. That eats directly into their operating margins.
It's a double whammy for them, yes.
So if the cost of moving consumer goods is going up and the cost of refining energy is going up, that brings us right to the doorstep of the Reserve Bank of India. We are staring at a classic supply-side inflation bottleneck. What does this imported inflation mean for the RBI's upcoming June policy meeting?
The overwhelming consensus among economists is that the RBI will maintain the status quo. They are heavily expected to hold policy rates steady.
No rate cuts, then?
None. A central bank cannot responsibly lower borrowing costs when imported inflation. driven by that 2% spike in crude and those inflated freight costs, is threatening to seep into the broader domestic economy. Any rate cut right now risks pouring gasoline on the inflationary fire.
That makes sense.
Plus, the RBI has to consider a massive structural shift that has already quietly occurred within the commercial banking system, all due to previous rate actions.
Let's dig into that structural shift. We usually talk about interest rates in terms of corporate borrowing or home loans, but what's the actual mechanism playing out on the retail saver side? Like, what's happening to the everyday fixed deposit?
We are seeing a massive repricing of liabilities for the banks. Right now, term deposits that earn lower yields, specifically those earning less than 7%, have surged. They actually make up nearly 62% of total bank deposits now.
Wait, 62%?
Yes. Retail savers are looking at the economic uncertainty and choosing to lock their money into these specific fixed income instruments just for safety.
Okay, let's pause on the banking mechanics for a second to make sure this is crystal clear for you listening.
Mm-hmm.
Banks take in deposits, pay us interest, and then lend that money out at a higher rate to businesses. The difference between those two rates is their net interest margin. So if 62% of a bank's capital pool is suddenly locked into these term deposits, how does that squeeze them?
It creates a really severe balancing act. The bank is on the hook to pay out that fixed interest to savers, which raises their overall cost of funds. Normally, they would just pass that increased cost on to borrowers by raising lending rates.
Right, but they can't do that right now.
Exactly. In an environment where the RBI is holding rates steady and economic growth is facing headwinds from inflation, banks can't easily hike lending rates without completely stifling credit demand. So they are forced to absorb the difference, which compresses that net interest margin you just mentioned.
Which brings us to a really glaring paradox in the recent data. We're talking about margin pressure on banks, supply chain friction for FMCGs, and inflation risks from crude. Yet, if you look at corporate India's Q4 results, net profits surged by 25.3%. On the surface, that looks like a booming, hyper-resilient economy. How does a 25.3% jump in net profits coexist with all the market gloom we just walked through?
Because it's largely an accounting illusion.
An illusion.
Yeah.
Is
When you look under the hood of that 25.3% surge, you realize it wasn't driven by companies suddenly selling 25% more cars or software or biscuits. It was driven primarily by non-operating factors. And the biggest single contributor was deferred tax adjustments.
I'm stuck on the accounting there. How does a tax adjustment legally become a profit on a quarterly earnings report? These are essentially paper profits, right?
They are entirely paper profits. A deferred tax asset occurs when a company has overpaid taxes in the past or, has carry forward losses. Accounting rules allow them to recognize that future tax benefit in the current quarter.
So it just makes the current quarter look better.
Right? It reduces their current tax provision, which massively inflates the bottom line net profit number. But no actual cash came in the door from operations.
Wow.
If you strip away those tax maneuvers and look strictly at the operating margins, the actual core business of making and selling goods, you see severe pain. The input costs we discussed earlier, from expensive spot market crude to rerouted shipping lines, are heavily eroding their operating profitability. So the headline number looks fantastic, but the underlying operational health is under intense pressure.
That context completely changes how you read an earnings report. Now let's look at the specific stock movers from the previous day's close, because despite the Nifty and Sensex bleeding, there were some massive trend-defying gainers. And as a reminder to you listening, we're strictly tracking the percentage movements here. Walmart spiked an impressive 14.62%. What is the fundamental trigger behind a massive pharmaceutical surge in the middle of a broader market sell-off?
For Walmart, it's a major regulatory victory. They secured U.S. FDA approval for a breakthrough drug called Zainich. This is highly significant because Zainich is designed to fight superbugs in complicated urinary tract infections.
Which is a huge deal. Antimicrobial resistance, these superbugs, is one of the most severe looming crises in global healthcare right now. Bacteria are evolving to completely ignore our standard antibiotics. I need the biological mechanics here. How does this specific drug actually bypass that bacterial armor?
It's a combination drug pairing a traditional antibiotic called cefepime with a novel compound called zidabactam. It really comes down to cellular warfare.
Okay, I love that analogy. Walk me through it.
So cefepime is the traditional weapon. It targets and destroys the bacterial cell wall. However, superbugs have evolved to produce defensive enzymes called beta-lactamases. Think of these enzymes as chemical scissors. They intercept the cefepime and cut it into pieces before it can ever reach the cell wall.
So the antibiotic is destroyed before it even works.
Exactly. And that's where zibactam comes into play. It acts as a novel beta-lactam enhancer. It binds to the bacteria's defense mechanisms and completely neutralizes those scissor-like enzymes.
Oh, so it's like a shield. The Zydbactam runs interference, taking out the defenses, which allows the traditional antibiotic to just swoop in and finish the job.
Exactly the dynamic. By neutralizing the defenses, it allows the cefepime to breach the cell wall and destroy the pathogen. It overcomes virtually all known resistance mechanisms for these specific infections. The U.S. FDA approval opens up a multi-billion-dollar global market for Wockhardt, which explains that 14.62% spike.
That is just brilliant pharmaceutical engineering, and Wockhardt wasn't the only player having a spectacular day. Sapria Life Science skyrocketed, up 20%, and in the tech manufacturing space, NetWeb Technologies surged 15.39%. But the market is a zero-sum game, and the losers took heavy beatings. Lincoln Pharmaceuticals bled heavily, dropping 16.67%. Delta Corp plummeted by 14.66%, and Natco Pharma fell 13.51%. We also saw a dip in the precious metals market, with gold slipping by 0.38% and silver dropping 0.88%. Let's talk about the pharma losers first.
If we look closely at those heavy losers, they reflect the exact macro pressures we outlined earlier. Take Lincoln Pharmaceuticals and Natco Pharma. Unlike Wockhardt, which had a unique proprietary drug approval, mid-tier pharma relies heavily on importing active pharmaceutical ingredients, or APIs.
Which brings us back to the shipping crisis.
Yes, they are highly vulnerable to the exact freight cost spikes and supply chain bottlenecks we discussed regarding the Middle East. When shipping costs surge, their margins just vanish.
And what about Delta Corp dropping 14.66%? They operate in the gaming and casino space. Are we seeing a pullback in discretionary spending?
Yes, that's the imported inflation biting the consumer. When everyday costs rise, luxury and discretionary spending like gaming and hospitality are the first things retail consumers cut from their budgets. Markets are pricing in a slowdown in footfall for their properties.
I want to touch on the precious metals, though. Gold slipped by 0.38% and silver dropped 0.88%. Usually, in times of geopolitical crisis, gold is the ultimate safe haven. Why is it dropping while the market burns?
It's purely a liquidity dynamic. While gold is a safe haven during severe market sell-offs, institutional funds often face margin calls on their equity portfolios.
So they need cash immediately.
Right. To raise cash quickly to cover those calls, they are forced to liquidate their highly liquid assets, which includes gold and silver. They're selling metals to cover their stock market losses, which creates that slight downward pressure.
That makes a lot of sense. Speaking of government interventions and margins, there's a crucial policy note regarding the energy space. The government has just slashed windfall export duties on petrol, diesel, and aviation turbine fuel. Let's quickly clarify the mechanism of a windfall tax. That's a levy applied when an industry benefits from an abnormal event outside its control, right? Like a sudden global spike in oil prices.
Exactly right.
So by slashing that tax now, how does it help the refiners?
Well, when global refined product prices were extraordinarily high, the government instituted the windfall tax, officially known as the Special Additional Excise Duty, to capture some of those abnormal profits from exports. But now, global refining margins have cooled. By slashing those duties, the government is stepping in to offer a buffer.
Lowering their export costs.
Yes. It makes Indian refiners more competitive globally. And this extra revenue helps offset the margin compression they are suffering from having to source that expensive alternative crude oil due to the Red Sea tensions. It's basically a fiscal lever pulled to keep the domestic energy sector breathing.
It's fascinating how a tax adjustment in Delhi acts as a shock absorber for a naval blockade in the Middle East. Now, speaking of liquids we fight over, like crude oil, I want to transition to the ultimate liquid, which is fresh water. We are stepping off the trading floor and into the laboratory because there is a massive breakthrough in material science regarding solar desalination.
This is a really incredible development.
It seems like scientists have developed a system that could fundamentally rewrite the economics of global water security.
It's a remarkable piece of engineering, and it solves two massive problems simultaneously. So traditional desalination, which is mostly reverse osmosis, forcing seawater through membranes, is notoriously energy intensive.
And expensive.
Very. But the bigger environmental disaster is the byproduct, which is highly concentrated toxic brine. When you extract the fresh water, you are left with this dense sludge of salt and chemicals. When industrial plants dump that brine back into the ocean, it sinks to the seafloor, suffocating marine life and just devastating local ecosystems. This new solar system produces fresh water without creating a single drop of liquid brine.
So basically, we're looking at a zero-waste, sun-powered water factory. But what is the actual physics here? How do you separate the salt from seawater without leaving behind a toxic sludge?
It relies on applied material science, specifically laser-textured metal panels. The scientists use high-powered lasers to etch microscopic grooves, channels, and peaks into the surface of the metal.
Okay, so it's not a flat surface at the microscopic level.
Right. When seawater is introduced to the surface, those microscopic textures utilize capillary action. Think of how a sponge pulls water upward against gravity. The textures draw the water in and force it to spread into an incredibly thin, microscopic layer across the panel.
And because the layer of water is so thin and the metal panel is sitting in the sun, it evaporates almost instantly.
Exactly. The metal is highly efficient at absorbing sunlight, so it rapidly heats up. The thin layer of water evaporates into pure vapor, which is then collected and condensed as safe drinking water.
But the salt doesn't evaporate. It has to be left behind on the panel. Doesn't that eventually clog up the microscopic grooves and ruin the capillary action?
That is where the geometry of the laser etching proves its worth. The microscopic channels are designed with incredibly precise angles. As the water evaporates and the salt begins to crystallize, the physical structure of the metal grooves literally pushes the solid salt crystals outward toward the edges of the panel.
Wait, it moves the salt by itself.
Yes, the salt crystallizes entirely dry and simply falls off the edge. It automatically moves the salt away from the evaporation zone. So you get pure evaporated water and dry, solid salt that can be swept up and sold for industrial use.
That's incredible.
It completely eliminates the creation of liquid brine, completely bypassing the need for massive fossil fuel-powered reverse osmosis plants.
For any professional looking at global resource scarcity, this is revolutionary. Water is the ultimate commodity. Disrupting the economics of desalination by utilizing passive solar energy and microgeometry, that changes the game for drought-stricken regions.
It really does. And it highlights a broader truth about innovation. The most profound solutions often come from understanding fundamental physical properties, like capillary action and light absorption, and manipulating them at the microscopic level, rather than just throwing more brute force industrial energy at the problem.
Absolutely. And speaking of understanding fundamental physical properties, that brings us to a final thought I want to leave you with today. We just discussed cutting-edge, laser-etched panels solving modern water crises. But sometimes the most astonishing feats of material engineering are ancient. Consider the 1,600-year-old iron pillar at the Qutub Minar in Delhi.
Oh, that's a perfect example.
Right. For centuries, it baffled scientists because it remains entirely rust-free despite standing exposed to the monsoon elements for over a millennium. Recently, researchers at IIT finally decoded the metallurgy behind it. They discovered its resilience comes from an incredibly high phosphorus content in the iron, combined with an ancient technique of forge welding. This specific chemical combination creates a microscopic, passive protective film called white on the surface of the pillar, permanently shielding it from environmental degradation. So I want to provocatively ask you to consider this. As we pour billions of dollars of capital into artificial intelligence and green tech today, how many more sustainability secrets are hiding in plain sight within ancient Indian metallurgy, just waiting to be reverse engineered by modern science? And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.